Hello everyone, and welcome to this 1-hour crash course on Excel for corporate finance. My name is Havish Madhupati, and I will tell you the reason you should watch this video. I'm not a finance guy. And I know it sounds very odd to say that as my opening statement, that I have created a course for Excel for corporate finance professionals, and I do not come from a finance background. But that is exactly the point. If you have done an MBA in finance or you are pursuing an MBA at the moment, definitely you would be studying these things. And while watching this course will surely help you refresh certain topics and help you understand how to create better Excel models, the target audience for this is really somebody who is starting their journey in finance or perhaps comes from a completely different specialization. My work is in analytics, and I work with supply chain teams with marketing, finance, HR. And because I work with interdisciplinary projects, I get exposure to heads of businesses, and I get the opportunity to learn different perspectives. Now, even though my core area is not finance, I am a part of meetings where finance is being discussed. And there is a lot of work I do in financial planning and analytics. So the way this course has been structured is that it's for everybody, whether you are or are not from finance. It is not the most advanced or the most deep course you will find in the market. But at the same time, it will tell you everything you need to know as a very high-level overview to help you get started. So the course is going to cover the critical tasks in corporate finance. So we're looking at the overview, which has project selection, WACC, which is the weighted average cost of capital, the capital structure, and cash flows. So we will look at project selection, where we have capital budgeting, we have NPV, we have IRR, the payback period, and the modified internal rate of return, unexpected events, scenario planning, and capital budgeting. Again, we look at different types of scenarios along with the net present value. In WACC and capital structure, we look at the capital structure and creating it in Excel. Using Excel and WACC, the capital structure options in Excel, the changes to capital structure, estimating WACC, sensitivity of WACC to capital structure, and finding the optimal WACC. And then finally, in operational budgeting, we look at operational budgeting, building a budget, and CAGR, that would be the compounded annual growth rate, and long-term assumptions. I run a firm called Havish M Consulting. It's an analytics firm. I'm a 40 under 40 in analytics for my work done in Excel Visual Basic. I am also a Microsoft certified trainer, Power BI certified, a Microsoft Office master, and Havish M Consulting is a Microsoft partner. I have been working on Excel for more than 15 years. The sort of clients with whom I work are across multiple sectors and functional areas. As you can see, I work with some Big Fours, investment banking firms, a lot of energy and power companies, PSUs as well. In terms of college engagements, I have engaged with 17 of the IIMs, and I have also judged competitions, conducted workshops, conducted trainings. If you're interested, you can also look at a podcast that I host called Conversations on Data, where I invite people from different areas of expertise to talk about their learning and takeaways for B School students specifically. You can also find my content on GitHub, on Medium, and videos on YouTube. I have more than 700 videos available on YouTube covering Power BI, Tableau, VBA, Excel at all different levels. And then finally, if you're interested in courses, I have different courses that are available, specifically tailored to B School students. So I have the Mega Analytics Bundle, that is all the 32 courses covering everything from Excel, PowerPoint, Word, SQL, NIME, R, Python, Power BI, Tableau. Then I have a course on Excel, which has everything from basic to advanced Excel. There's one on Power BI and Tableau combined, separate courses on Power BI and Tableau, a combined Office bundle that has PowerPoint, Word, and Excel. Then I have a course on introductory data science, Python, R, and 9. And then finally, some combination bundles as well, where different courses from different tools have been picked up. So we have the marketing and the finance bundle. So I hope you have fun watching this video. Of course, the files have not been given in this video. If you're interested to practice alongside, and if you would like to get a certificate, then I suggest to hop over to my website and purchase the course. For any questions, any doubts you have, you can reach out to me on LinkedIn or either on email, or just put a comment on my YouTube channel. Hello, everyone, and welcome to this course on corporate finance. Now, as a business, when we are looking at investments, we can either issue stocks or bonds, but that is the investment side of it. From a corporate finance perspective, we are looking at applications for the corporate user. And for a finance professional, what we're looking at is a roadmap. And what it helps us with is decision making. Now, what exact purpose does corporate finance solve? So what are the questions that corporate finance helps us answer? Now, the major tasks that you would see in corporate finance would be to look at profitability levers. Now, this could be things like operating activities, so deciding the price, the volume, etc. We're also looking at budgeting and planning, which would be creating yearly forecasts, quarterly forecasts, annual operating plans. It also includes developing a strategic vision for the business and also resource allocation and optimization. Then we also look at reporting. Now, reporting is something where corporate finance works hand in hand with accounting. The difference being that accounting typically looks at historical data and figures, while corporate finance looks at what comes ahead in front of the business. Do keep in mind that both accounting and corporate finance has elements of financial reporting in it. Management accounting also has an overlap with this, but we will not get into that right now. And the final task that we have is variance analysis, which essentially looks at providing financial information to decision makers in the organization. And next, we look at project selection, and this would be the most visible part of corporate finance. And this enables the investment decision making for the firm. So you're looking at things like capital expenditure on expansion of a plant. If you're a bricks and mortar play, you're looking at opening new stores and maybe acquiring a smaller competitor. And then when we look at evaluating projects, we look at the projected cash flow, and we also look at the discount rate. And the simple correlation here would be that the discount rate will reflect the firm's risk and the risk of the project itself. Now, what level of confidence do you have in the project cash flow? So if you have a higher confidence, then the discount rate would also be reflected in that. And similarly, if you have a lower project risk, or if you have higher confidence, the discount rate would also be lower. Obviously, the objective here would be to have a lower discount rate. Now, obviously, in terms of projects can be a one-time project, something like a store opening. It can be a repeat project. For example, a marketing plan or an initiative. And it can also be mutually exclusive projects. Now, mutually exclusive projects refer to a position where we have to choose between an alternative. For example, if I have to decide between launching a new product line versus launching more variants in the existing product line. Now, when it comes to selecting projects, we are looking at obviously quantitative criteria for making decisions. And some of the most common criteria that we look at is NPV, so that would be net present value. We look at IRR, that would be the internal rate of return, and the PBP, which is the payback period. So something really important, and something I'm sure all of you would have heard of, is the WACC, or the weighted average cost of capital, and the capital structure. Now think of it this way. As an individual, you borrow money from a bank for a personal loan, for a home loan. Similarly, as an organization as well, you have the option to borrow money from a bank, from the stock market, or from the bond market. Now, the fundamentals of borrowing remain the same, but the interest rate is based on the riskiness. So if the business is more stable, if your past record has been good, then you pay lesser. And of course, if the past record has not been good, and if you have been incurring losses, you have to pay a higher rate. Now, you can think of the WACC as the interest rate for the firm. And this is based on the risk and the type of financing. The risk would be the element of risk depending on the past performance of the business and the future possibilities for the business and the type of financing that you're going ahead with. Now, there are two options that we have here. We have debt and equity. Now, when we look at equity, we are looking at something being provided by the stockholders. Now, this is risky because there is no guarantee in the case of bankruptcy. Hence, they're going to ask you for more money, because if the company goes bankrupt, they don't really get anything out of it. On the other hand, if you look at debt financing, it is clearly cheaper than equity financing. And you can take debt from either the bond investors or directly from banks. And because there is a guarantee in the case of bankruptcy, and you have an obligation to make regular interest payments, it is typically cheaper than equity financing. Now, the trade-off is that we have the cost of capital versus the risk from interest payments. And that is where the decision comes between debt and equity. And this is where we come to the capital structure. And the capital structure is nothing but the amount of debt versus equity. And this is a key decision for the firm, because if you have too much debt, you have the risk of bankruptcy. And if you have too much equity, then you have low stock returns, and your shareholders might not be happy with it. Now, is it 30-70? Is it 50-50? This is what the decision makers and the people at the top, the business leaders, have to deliberate and decide, and drive the weighted average cost of capital and look at the ideal capital structure, which of course depends on the industry and many other factors. Now let's look at the cash flow and budgeting aspect. Now, clearly, corporate finance helps us with a business plan for the future. And the operational budgeting helps companies forecast things like sales and cash flows. Now you have to make good assumptions because there are a lot of forecasts that you have to make. That could be based on the pricing. So whether there will be price changes in the future, whether there'll be a cost impact in the future. So if your raw material cost is increasing, what impact would that have? And also things like market share. So are you expecting to increase the market share, and is it a zero-sum game or not? So is the size of the total market increasing as well? Now, this is a difficult process when you're estimating cash flows because you have to estimate both two things. So both sales and expenditure. And one of the most common ways of doing this would be to look at the CAGR, which is the compounded annual growth rate. And this estimates how much the sales will grow on a % basis. And this can depend on things like marketing spend, advertising spend, new initiatives that the business is undertaking, how the competitors are behaving in the market as well. Now, from a sales growth perspective, a growth in the market of the firm, that means that I'm not just increasing my size, but the size of the entire market is growing. So I'm educating the market. For example, if you look at the plant-based and the vegan market, the entire market size is growing. We are growing as well as the competitors. Or you're looking at a growth in the market share, which means it's a zero-sum game. We are increasing our slice of the pie. The market size as such is not increasing, but our share of that is increasing. And of course, in the hands-on examples, we'll be looking at NPV and IRR. Now, internal rate of return is very common in business, but we have drawbacks. And of course, in the live example, we will do internal rate of return, net present value, future value, modified internal rate of return as well. Hi, everyone. Let us look at the problem statement. So what we have here is the occupancy rate, the student rent, bedrooms, and the summer weekend rate. So we have rooms with us, and we're expecting 60% occupancy rate. The student rent is $1,000. There are 4 bedrooms, and the summer weekend rent is $1,500. What we want to create here is the revenue and cost. Now, if I just show you the very first row, you can see that these are very simple formulas that we have written. So we are multiplying the number of bedrooms by the student rent. So that would be $4,000. And for the cost, what we are doing is we are taking the upgrade and maintenance per month, and we are adding the property tax rate multiplied by the discount value multiplied by the market value, which is, let us say, $1 million. And this is being divided by 12 since we want to find that for 1 month. So if you look at this calculation here, the result is $2,041. And if we add that to 500, we get $2,541. Now I'm going to drag it down, but not for all the different months that we have. We want to do this only for, let us say, Jan till May. The same goes for the cost as well. And then we want to resume in September. So I'll just copy the formula like this. And for the month of June, July, August, what we want to do is to look at the summer weekend rate. So we are going to take the summer weekend rate, which is I-20, and then multiply that by 4.25. Let us assume that 4.25 is the number of weeks in a month. And let's copy it down. And then for the cost, what we are doing is we are taking the same formula here as well. But because it is the summer weekend rent, we are expecting that the building owner will not be providing the utilities and we have to pay for it ourselves. So we want to add the utilities per month as well. Let us copy the same format everywhere. Since these are calculations, I'm coloring everything in green. And then we want to add up all of these. Let us put a green color here as well. And we get $55,125 revenue and then $32,300 for the cost that we have. If we subtract the two, we get a cash flow of $22,825. In the next video, we will look at the discounted value, assuming that the property is being owned for 60 years, and try and see if this cash flow is something that will be sustainable and whether this is something that is a good return on investment for us. Hello, everyone. In the last example, we calculated the revenue and the cost, and we found out the cash flow. What we would like to do now is to assume that we have the property for 60 years, after which we will be selling everything. And we want to know the cash flow for each one of these years, as well as the discounted value for each year. Of course, we will need some assumptions to begin with. So let us say that the land value is $7 million. I'm just going to color everything here, and let's make this a currency. I'll change it into blue color. Then we have 3 percentages with us. So we're assuming that there would be an annual land appreciation of 4% and the rental rate increase of 4% as well. And the discount rate is 6%. Now the discount rate obviously can be higher or lower. And we will see that if we make the number higher or lower, what level of confidence do we have in the future cash flows? To begin with, for the first year, we are just going to take the value from the calculation that we did in the previous example. So let me change it into black color. And you can see that the first value is nothing but 22,825. And for the discounted value, what we want to do is to take our cash flow, and then we want to divide it by 1 plus my discount rate. We'll put a $sign here, to the power of the number of years that we have, like this. And that gives me 21,533. Now that is for the first year. Now you would notice that if I make this 6%, 0%, we get the same number, right? Or if I make this 2%, then the difference isn't really much. But the higher the discount value, the higher the risk that we have. So if I make it 6%, our discounted value also decreases. For the second year, we want to take the value from the first year, and we want to multiply that by 1 plus F4. And the logic for doing this is that we are taking the previous year's cash flow and then essentially doing 1 plus 4%, which is 104%. Since we're expecting that every year there will be a rental rate increase. For the discounted value, we can just drag it down in all the cells. Let me just make sure that these values are also getting dragged down. So we'll first do this, and then we'll do the same thing here as well. Now, after 60 years, we intend to sell the property. And for this, we want to calculate the future value of the investment. Now, the rate that we are going to select is 4%, which is the land appreciation. After that, what we want to do is to take NPR, that is the number of years. So we'll take 61. And then we want to take the payment period being blank. And for the present value, we will take $700,000, comma, and we are choosing the end of period here. So that would be 0. And you can see that we get our final number, that would be the future value that we have. We also want to make sure to multiply this by -1 so that the result comes as a positive number. So we have 7658,288. So we have about 7.5 million. Now, what we want to do is to look at the value of property, the sum of discounted cash flows. So we will simply do equal to the sum of C2 all the way till C62. And we get 996,000. And if you notice, that is very close to the market value that we have today. Now, remember, that is because the discount rate is pretty high at 6%. And that is why you notice that as we go down, the number decreases because we have lesser confidence in the fact that our values in the future will be high. Now, if I make it 0%, just as an example, you will notice here that my value shoots up substantially and we're getting $13 million, which, to be honest, might be a little unrealistic. So what we want to do here is to keep something like 5%, and you notice that now it's 1.38 million. Of course, the objective of a business would be to try and decrease the discount rate. So the more confidence that we have in the operations, we are able to reduce the discount rate. Obviously, in this example, we have assumed that the rental rate increase, land appreciation, everything will be constant, but it is possible that that number changes as well. Hello, everyone. Continuing from the previous example, we have calculated the value of property, and we want to look at the net present value. That will help us decide if we want to proceed or not. Now, to do that, I first want to write NPV, and to calculate the net present value of an investment, we want to take the rate, that would be 4%, and then the values would be B2 to B62. Now, this doesn't really look right. And the reason is that we haven't really mentioned the negative number, which means the cost of the property. Now, here, if you look, we can see that we are assuming $1 million. So I'm going to add some blank cells here. And we will see that this is -1 multiplied by 1 million. And let us use the same format here as well. And then in the formula, we will update it to include this cell as well. So from B2 till B63. Something doesn't seem right. Okay, I seem to have selected my F4. It should be my F5, which is the discount rate, right? Now you notice that my NPV is coming as negative, which is not a good thing, which means that we should not proceed with this entire plan that we have. We would like it to be positive. Now imagine that we managed to procure the property at a slightly lower cost, let us say at 900,000. And you immediately notice that it flows into all the calculations and immediately our NPV becomes profitable, or rather a positive number. More realistically, let us say we managed to get it at 950,000. And you can see here that the net present value is positive now at $83,000. Let me copy the same format here and change it into a black color and make everything center aligned like this. Hello everyone. In the previous example, we saw how we can calculate the net present value. And let us now look at the internal rate of return. The internal rate of return is also something which will act like a complement, especially when you compare it with the discount rate. To calculate it is really simple. We want to find the internal rate of return for a series of cash flows. So I will select from B2 till B63. The guess value is just an estimator. It is an optional argument. You can either put it as 0.1, which is also the default. Mostly you will not need to change it, but in case you don't get the result you expect, you can change it as well. So I'm going to put it as a 0.1 or 10%, and I get an IRR of 6%. Let me increase the decimal point and we get 6.29. Now, if you look at the internal rate of return, it is higher than the discount rate. And that is exactly what we are looking at. And these are related because if the internal rate of return is higher than the discount rate, my net present value will also be positive. On the other hand, let us say that the internal rate of return was lesser, right? So if I make this, let's say 4%, that might not be a good thing. So to show that, let me make my discount rate a little higher. I'll make it 7%, which means it is higher than the internal rate of return. And immediately you notice that our net present value becomes negative. If my discount rate is exactly 6.29, you will notice that the net present value is really small, which essentially means that we are right in the middle. It's neither positive nor negative. At a 4%, it's really high. And at 8%, it's really high as a negative number. So let's set it to 6%. And this is something good because if my internal rate of return is higher than the discount rate, that means my net present value will be positive and we can go ahead. The internal rate of return obviously is a very common metric that organizations look at when it comes to deciding about a project. Hello, everyone. In the previous example, we have seen the internal rate of return. And we saw that if the internal rate of return is higher than the discount rate, that's a good thing. But there is a very big assumption there. And the assumption is that we are assuming that all of these cash flows that we are getting, we are able to reinvest it. But what if we are not able to reinvest it at a value higher than 6%, which is the discount rate? And that is a valid assumption because if we did have a way to reinvest it at a higher value, we would have done it in any case. So let us assume that our reinvestment rate is a little lesser at 4%. And for the modified internal rate of return, we will say that we have MIRR, which is the internal rate of return for a series of periodic cash flows, considering both the cost of investment and interest on reinvestment of cash. That means the reinvestment of the cash flows that we have. The values would be the same values that we had selected earlier. So B2 till B63. And the finance rate here would be 6%, and the reinvest rate is a little lesser at 4%. And you will notice here that we are earning 5.35%. And that's interesting because the modified internal rate of return is actually lesser than the internal rate of return. Looking at the IRR, we thought that the NPV is positive, which is good for us, and we should continue with the project. But looking at the modified internal rate of return, it might probably not be a good idea to continue with the project. Let us also look at a very dirty but quick method here called the payback period. Now, if we have invested 950,000, we would expect our cash flow to return that money to us, right? So if we add up all these numbers, we essentially want to see at what point has my $950,000 come back to me. So if I keep on dragging it down, you will notice that it takes us 25 years for us to get the money back. So this would be from B3 till B27. So from B3 till B27, let me change the color here. So 25 years, everyone, is what it takes for us to get our initial cash flow back, or rather our initial investment back. We have seen the net present value, the internal rate of return, the modified internal rate of return, and the payback period. Now, ideally, we would want, from a cash flow perspective, that we have 100% occupancy, but that might not be realistic. If you want to calculate the cash flow, that would be the student rental revenue plus the summer rental revenue, that is for these 3 months, June, July, and August, minus the cost. Let us see how we calculate that. So let me just zoom in. First, we will look at the student rental revenue. So this would be for 9 months, and we are taking the number of bedrooms multiplied by the student rent. Now, for the summer rental revenue, we are taking 13, right? We are assuming that there are 13 weeks that we have, and that would be multiplied by the weekend rent. And I would multiply that by the occupancy percentage. And finally, we want to reduce the cost here. So we want to do 12, which would be for 12 months, multiplied by the upgrade and the maintenance cost. So that would be I-26 plus we have the property tax rate multiplied by the value discount multiplied by the market value. And we get 8,675. Now, this is obviously at a very low occupancy rate, and we would like to see this for higher occupancy rates as well. Let me just put the dollar sign here. We would need a dollar sign everywhere except M3. So let me do that. And if we drag it down, these are the numbers that we get. Clearly, when the occupancy rate is higher, we are also expecting a higher cash flow. And there's quite a big difference between a 10% occupancy and 100% occupancy. But these are unexpected events and not really in our control. So while we can try to increase the occupancy level, from a forecasting and a planning perspective, we should account for all the possibilities. We have seen the internal rate of return. We have seen the modified internal rate of return and the payback period. And in the last example, we also saw how different occupancy rates will have an impact on the cash flow that we have. Now, IRR is very common in business, but it has its drawbacks. Now, one of the drawbacks is that there is always a reinvestment risk, right? Whether we'll be able to reinvest it at a good value or not. And the other problem is that percentages can be highly misleading. For example, while a 10% and a 20% might look very different to each other, you have to understand that from a dollar perspective, 20% of a small number might be lesser than a 10% of a high number. So if I say I'm looking at 10% of $1 million versus 20% of $50,000, a higher internal rate of return, 20%, is nothing to be excited about because we're looking at dollar terms. And the final thing is that we might have losses in some years and profit in some years. And this will result in a wrong IRR calculation. And if you think about it, this is fairly common where we can have this problem where we have losses in some years and profit in some years, and the IRR calculation doesn't work properly. What I want to show you here is what would happen for these different occupancy rates and in terms of the impact on my net present value. So I'm going to take this 8675 and put it in K14 as a pay special value. Now remember, all the cells below this are connected to the cell above them. So the net present value here is coming as negative 410,000. So I just do a pay special value. And let's copy the format as well, like this. I'll do the same thing for 20%. So pay special value, and then copy the net present value, come back here and paste it. Then let's do it for 30%, paste, copy, and pay special value. Let's do it for 40%. Now, I hope all of you can see that as the occupancy rate is increasing, my net present value is also improving, which means that the number is also increasing. So let's do it for 60%. And now it's getting quite close to 0. And let's look at 70%. And let's look at 80%. I think at 80%, it should become positive. So as you can see, it has now become positive 27,000. So let's continue with 90 and 100 as well. Excellent. Let's copy the format everywhere. Now, if you think about it, unless we have confidence that we have at least 80% occupancy, my NPV is going to be negative. And that's not good, right? Because that's a big assumption and a big target for the business to have 70% occupancy. And having the scenarios in front of you is very helpful because it helps you evaluate whether it's a good idea to undertake this project, considering you need to have minimum 80% occupancy to essentially turn a positive net present value. Hi, everyone. Let us again look at the weighted average cost of capital and the capital structure. Now, credit ratings are provided by different organizations, and I'm sure you must have seen them before, where a AAA is the best, followed by AA, a single A, triple B, double B, a B. And after that, we can even have a triple C, double C, a C, and then a default. Now, we have already seen that the cost of debt is always going to be lesser than the cost of equity. One more advantage that an organization has when they are choosing debt over equity is that it acts like a tax shield. What that means is, if an organization typically is earning $1 million and we expect them to pay 25% of that as the tax rate, they end up earning only $750,000. And because the pre-tax cost of debt is 5.47%, the after-tax will only be C2 multiplied by 1 minus 25%. And if I copy it to the right, you can see that the after-tax cost of debt is even lesser than the pre-tax cost of debt. In the case of the equity, though, it does not act like a tax shield. So even after tax, we essentially get the same number. Now, the WACC can be 50-50, or it can be a different combination. And to find the weighted average cost of capital, we simply have to do 0.5 multiplied by 4.1% plus 0.5 multiplied by 10.25%. And as you can see, this gives us the weighted average cost of capital. It goes without saying that for organizations to come to a credit rating of AAA is really difficult. Just like as an individual, for you to get a credit rating of, let us say, 825 or 830 is really difficult. A lot of organizations will never reach a AAA credit rating. Now that we have calculated WACC at 50-50, let us now look at the WACC using market weights and the book weight. Now we know that debt is expensive, and I want to introduce you to something called the coverage ratio. Now the coverage ratio is what is going to drive the debt earnings, and the way we calculate the coverage ratio is we look at our EBIT, which would be our earning before interest and tax, and we divide that by the interest cost. And the way we look at it is that higher debt levels will lead to lower coverage ratio and debt earnings. Now, if you look at the example, you can see that we have the WACC at 50-50, which we had calculated previously. And we also have the proportion of debt that we have. Now, what is interesting here is that even though the debt for a AAA credit rating company is much lesser, less than half of a credit rating with a B, the proportion of debt is also lower. And the analogy here would be that the people who the bank would charge a lesser interest rate to are not really the people who are seeking a loan. And the people who are seeking a loan, they have to pay a higher interest rate. So you would notice here that the proportion of debt for a B rating is actually 75%. Now we also have our EBIT divided by interest, and these have to add up to 100%. So the weight of equity and the weight of debt. And you can see how the proportion is changing everywhere. Now, if you look at the WACC using market rates, what we're doing here is to multiply C14 by C7. So we have the weight of debt, 9.5%, multiplied by the after-tax cost of debt. So 9.5 by 4.1%. And then we have C3, which is 10.25%, the cost of equity, multiplied by the weight of the equity. And we get 9.67%. When we look at the book weight, we are looking at C13 by C7. So now we are multiplying 5% by C7, which is the after-tax cost of debt, 4.1%. And then we are multiplying, we are adding the opposite, which is 1 minus 5%, which is 95% by C8, which is the cost of equity. So 5% here being the debt and 95% here being the equity. And you can see the numbers here. I can also copy them across, and this gives you a sense of how the numbers are in comparison to the original WACC that we had. The takeaway here is that when you're looking at the capital structure, you also have to keep in mind the credit rating of the organization. And if the credit rating of the organization is not the best, by modifying the proportion of debt and equity that you have, you can actually improve the weighted average cost of capital as well. Let us see how different corporate actions can have an impact on the WACC. So I've taken 4 scenarios here. We are looking at a stock buyback, which will reduce the equity by 2% and increase the debt by 2. A stock issuance, which will be the opposite. So if you're issuing more stock, the equity goes up by 2 and the debt reduces by 2. In the case of bond issuance, we are looking at 4% increase in debt and 4% lesser equity. And a bond redemption will be the opposite of that, 4% reduction in debt and 4% increase in equity. Now the formula here is very simple. If I can align everything to the left to show you how it works, you can see that we are multiplying C14 by C7, but we're also adding 2% to it, which means that to this weight of debt, we are adding 2% and we are subtracting 2 from C15, that would be the weight of the equity, and multiplying that by C3. C7 here being the cost of debt and C3 here being the cost of equity. And if I copy it across, you can get a very interesting pattern here, and you can see that the number decreases and then increases. The idea here is that whenever you hear in the news about organizations that are doing a stock buyback or a stock issuance, for example, you can see how that has a direct impact on the weighted average cost of capital as well. And while it might sound exciting to reduce the weighted average cost of capital, you have to look at the fact that if you are taking in more debt, that also means that you have to give an interest payment. And if the market performance is not going to be in line with your projections, it is going to have an adverse impact. As a continuation of the previous example, where we had looked at different corporate actions and the impact that it would have, we are also looking at the EBIT coverage here. For example, here it is 20 and here it is only 1.8 times. Now these numbers are in $1 million. So assuming that the normalized 5-year EBIT is 360 million, the debt given on a total capital of $1 billion would be 9.5% of 1,000. So here it would be 95. Now, the thing here is that I would be multiplying 5.47%, which is the cost of debt, by 95. And here I would be looking at the maximum total debt implied by the rating, which would be my normalized 5-year EBIT divided by my EBIT coverage divided by the cost of debt. And if I subtract the two, if I subtract maximum total debt and I use 95, we get 234. Now, as we do this for companies with different credit ratings, you can see the difference here. So while the risk might be higher in case you are taking in more debt, you can see that the spare debt capacity for a AAA is 234 million. But in the case of a B-rated company, it is 1.1 billion. Now that is great because a B-rated company would require to take more debt. The risk here is in the case of a downside. So in case there is a recession or the market performance is not up to the estimates, what happens now is that we are expecting a reduction in the EBIT from 360 to 200. And what that means is that now when we do our calculations, the same calculation that we did before, our downside spare debt capacity reduces from 234 to 88. Now, this might in absolute terms not make a big impact to a AAA credit rating company. When you look at it for a B-rated company, you can see that it reduces from $1.1 billion to just 396 million. And that is something you really have to keep in mind because you have to look at different scenarios where the market is going to perform well and the market is not going to perform well. And you saw that with a normalized reduction of 360 to 200, the impact it had on my spare debt capacity. Something you might also want to do is to look at the cost of equity, assuming a beta of 1. To understand what it is, you can just Google it. And what it tells you that as a step to calculate the cost of equity, you want to quantify the beta, which is a number that reflects the volatility of the firm's stock relative to the market, right? It is a very common factor that is used in calculations for the weighted average cost of capital. Now we are looking at a beta greater than 1, which reflects a company with greater than average volatility, and a beta less than 1 corresponds to below average volatility. Now, obviously, we would expect that a company with a better credit rating is something where we have more confidence in the company's future performance. So here it says that a beta less than 1 corresponds to below average volatility. Now, a AAA rating, we are looking at 0.90 as the average stock move. And as you can see, the number keeps on increasing. And for the cost of equity as well, it keeps on increasing. Now, the beta we have calculated here is nothing but C4 divided by C5. So my average stock move divided by the market move, which would give us the volatility. And if I drag this to the right, and after this, when you look at C3 multiplied by C10, which is the cost of equity multiplied by the beta, we get 9.23%. Now, do not be shocked when I copy this formula to the right. While a 31% might seem like a really large number, you have to understand that a rating of a B is not really that good. And investors would really be looking at getting more money because we are not confident of the future performance of that company. The company might not even exist after 5 years. Hence, it might not be a complete shock to find such a high number here in the beta adjusted cost of equity. To end this particular topic, we would discuss about the optimal WACC. Now, as an organization, we are focused on gunning for more projects, and we're also looking at improving our credit rating. But you would not blindly look at a triple A rating and assume that that's better than a double A or a single A. For example, if you look at the WACC here, the best WACC, the least number, is actually the one with a triple B. And as you improve the rating, the WACC essentially becomes a little worse. So that is the balance that the company has to create here. So for example, if we are looking at the probability percentage that you will have earning before interest and tax, you can see that, let us say at 90% probability, we are expecting a no profit, no loss, essentially a break even. A 70% probability of $50 million, a 50% probability of $100 million, and so on and so forth. If I put 100 in the EBIT, which means a 50% probability, the problem here is that my spare debt is essentially negative. I do not have any spare debt to work with. And you have to keep in mind that debt might be required. And also, another angle to look at it is in terms of the number of projects that you would like to gun for. And if you're essentially looking at a better rating, you may not be able to do this effectively. For example, if you are looking at an internal rate of return, so the percent of projects would be 80%. So let's say 80% of projects with an IRR greater than 5%, 70% with an IRR greater than 7%. And the IRR percentage, as it increases, the percentage of projects decreases as well. So do keep in mind multiple factors when you are deciding on the optimal WACC. And while as a beginner, it might be fun to look at the AAA rating, you have to understand that organizations might consciously want to be not at a AAA, maybe a AA or even an A might solve their purpose. Now that we have looked at the profit levers, let us also look at the operational side of it. So broadly, we are looking at short-term versus long-term. Short-term is what we usually refer to as the worm view, and the long-term would be the bird's eye view. And while short-term focuses on the operational activities, so for example, you're looking at forecasting sales, for example, you are looking at long-term in terms of the overall strategy for the organization. So in short-term, we are looking at forecasting sales as an example versus creating the overarching strategy for the organization. Also, typically a short-term approach would be a bottom-up approach. For example, consolidating budgets and plans from people at the grassroots level and then aggregating everything. And for the long term, we will be typically looking at a top-down approach. For example, if the organization has a vision of growing by 15%, then we break down that vision into actionables and we try to make that happen. Let us now look at the Excel calculation for creating a cash flow and for doing the budgeting. Now, these calculations have already been put in. You can see them in the file, but I'll just walk you through them. So what we're looking at here is some inputs to the model. So we can see that we have a CAGR of 8%, a 7% interest rate on debt, 45% dividend payout, and 40% tax rate. There are two products that we are selling, and the cost of goods sold as a percentage of sales is 30% and 38%. And then our selling, general, and administrative expense would be 12%. So if we look at the calculations here, we are looking at 4 quarters and we have the complete year. And the revenue here is nothing but the sum of product 1 sales and product 2 sales. So if you're looking at a CAGR of 8%, we are essentially dividing that by 4 to get 2%. We are doing 1 plus 2%, that would be 1.02. So if we have done 1980 in January, we are expecting to do 2019 in April. And these formulas have just been copied across. And then for the full year, we are finding the sum of all the 4 quarters. Similarly, for the operating cost, we are looking at the cost of goods sold for product 1 and product 2. So for product 1, we are looking at product 1 sales multiplied by 30%. And here we are looking at product 2 sales multiplied by 38%. The SG&A cost will be the total revenue, and the percentage here as an assumption we have taken as 12%. And this is the sum. Now the earning before interest and tax is nothing but the revenue minus the operating cost minus the SG&A cost. The interest is on the debt. So we are looking at a 7% interest rate on debt. The EBT would be the EBIT minus the interest. Taxes would be 40% of the EBT. And when we're looking at the net income, we are looking at the EBIT minus the interest minus the tax. So we are essentially reducing that by the interest on the tax amount. And of course, we have the dividends as well. So we are looking at a 45% dividend payout. And the retained earning here would be B14 minus B15. That is the net income minus the dividend, which in this case is $238,000. So while this is a very simple model that has been created, expect to create more complex models, and a good model will always have a lot of levers in it so that people can manipulate all the parameters. CAGR can also be used for long-term business planning. So we essentially are working on the same data that you saw in the previous example. The difference here is that we also have a seasonal effect here. So we have a 0%, -3%, 2%, and 6%. And this would be a more realistic scenario because we expect different quarters to behave differently. Now, the calculation that we have here changes a little bit. So what we're doing here is to multiply the product 1 sales by 1 plus J2 divided by 4 plus the -3, which essentially is a -3%. And as you can see, for each one of the quarters, we are doing -3, 2, and 6%. Now, proportionately, as your earnings increase, your expenses are also going to increase. That is why you notice that for the retained earnings, there is no difference that happens. Now, obviously, that will not be true in an actual setup because you have factors like economies of scale, growing expenses as you scale the business, and you will not expect them to grow proportionately. But this was just to give you an idea as to how CAGR can be used for long-term forecasting as well by having the seasonal effect in it.